Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended Wednesday, August 28th, 2013. This has been one of those kind of strange weeks to be in the market, though, because there's been a lot of people on vacation, a lot of the desks are empty, and I think that was actually a plus because we saw obviously three major events hit the markets this week, and it might have been more catastrophic had it been a full trading week in October or November. First of all, we had the Syria event. We saw some saber rattling from the United States. Secondly, we heard that the United States will hit its debt limit in October, middle of October, and we all knew that, but again, it's being brought back up into the actual situations. And also, we saw that there was a glitch in the NASDAQ. There was a 3-hour pause in trading, which in the past has caused some pretty big ripple effects through the economy and through the market, and that didn't happen this time. So that was kind of amazing, and that really impacted our flows. While the market was actually down only about a half a percentage point for the whole week. So even during all this turmoil, we saw that the S&P and the Dow actually were down about 0.5%, and then we saw that the NASDAQ, the one that had the failure in it, was only down 0.19% for the week. Well, let's see how these events actually turn around and impacted the flows as we look at our macro groups. On the equity side, we saw that there was actually about a $2.2 billion inflow. Again, remember, this is only considering conventional funds. We're ignoring ETFs. Taxable bonds actually saw an inflow as well, very small, 0.2 billion. And then when we saw munis take another 1-2 punch, it's lost about $1.7 billion. And then money market funds saw, the big share money come in, about $5.5 billion of net new money coming into their group. Well, let's take a look at how this actually impacted on an equity, bond, and fixed income basis to see how it actually panned out. If we take a look at equity funds, we see that actually this was a pretty good week as far as flows went. Even though we saw a 0.58% decline, it was the second consecutive week we've seen equity funds lose money, but we've, again, for the 34th consecutive week, they've taken in money. Retail investors keep putting money back to work, about $2.2 billion. Year to date, that pans out to be about $134.7 billion net new money coming into their coffers. And how we break this out, if we look at domestic equity funds, we saw about $1 billion net new money coming into their group, and then non-domestic equity funds took in about $1.2 billion. This is the 13th consecutive week they've seen positive inflows. If we break that down into another grouping, we see that large cap funds again were the area that investors wanted to flock towards. They saw about $527 million net new money coming into their group. And then we take a look on the non-domestic side, it was the developed nation countries that actually helped us out. So it was the international equity group, not the emerging markets as it has been in the past. About $1 billion came into the developed nations end of the mutual fund arena. Now, if we actually break this down even further, now take a look at ETFs, we see there was a complete tale of two cities. This is the third consecutive week that we've seen outflows, and that we saw about $3.1 billion leave the coffers of ETFs. Now, this is kind of weird because what we saw is investors actually flocked towards, and this is a kind of flight to safety. We saw some treasury actually interest, and we also saw some gold interest. But interesting enough, we saw that the biggest inflow came to the Spider Gold Group. That was about $343 million. But on the flip side, the second biggest loser was basically the Vectors, the Market Vectors Gold Miners Fund, and they lost about $697 million. So that was kind of a weird thing. But when we saw the increased volatility, two things that we expected. We saw the SPY, the Spider SP 500 lose about $1.3 billion. Then we saw Spider Dow Jones Industrial Average lose about $503 million. So that was, kind of what we had expected as far as flows go. When you have some volatility, people are getting out of the big boys. But certainly there was a dichotomy in the gold area. People weren't talking the same talk. Maybe it was a difference between one is a commodity and the other one's a miner. Well, let's go ahead and take a look at our fixed income group to see what happened in that group. We see that for the third week in four, we saw that there was inflows, and it was about $0.2 billion net new money coming in there. It's the first week in three that we've actually seen positive returns. There was a 0.08% return, so just basically on the positive side. But interesting enough, where we saw the big plays, we saw loan participation funds taking about $1.3 billion. That's usually a subset of our corporate investment grade debt funds group. And actually, if we include those by themselves, we see that actually intermediate investment grade debt funds probably took a hit, probably were down maybe around $400 million for the week so far. And another interesting piece that we saw, and by the way, loan participation funds took in money for the 63rd consecutive week, so investors are certainly looking for that reset it feature as far as interest rates increasing. And then we also saw that flexible portfolios took in about $700 million as well. On the bottom side, though, where we saw money actually leaving the coffers was, again, on the government side. So government and mortgage funds actually saw the biggest redemptions. About $511 million left the coffers from that group as well. Well, now let's go ahead and take a little bit focus dive on the ETFs. Now, this is a very small group, so the numbers aren't very big, but overall we saw that there was about outflow of about $900 million, just a little bit short of $1 billion. And where we saw some of the big money coming in was really kind of a weird thing, is that we saw the Spider High Yield Fund actually take in about $230 million, and then we saw the iShares Short Treasury Bond Fund actually hand back about $930 million. So we had kind of a dichotomy there, but what we expected at the very bottom of that was tips and investment grade debt funds actually losing money. So it really wasn't that odd of an event at all. Again, the high yield might have just been some trading factors. And when we take a look at ETFs, we got to know that in fact there's some institutional reasons why money is going in and out. They're not because of the trades that you and I are doing. This is basically institutional investors either playing the discount or playing the premium, and that's maybe why we saw some high yield moves in the middle of the week as well. Well, let's take a look now at what happened in the muni debt fund arena. Actually, as I was telling you, there was a 1-2 knockout punch from Detroit several weeks ago that happened, and it certainly continued to be on a slide. For the 14th consecutive week, we've seen outflows, and it was $1.7 billion for this week. If we break that down even further, and in fact, by the way, this is the 4th consecutive week we've seen negative returns for this group, about 0.22%. But if we break it down with further detail, we see that national munis really took the biggest, punch in the jaw, about $1.1 billion in outflow from that group, and we certainly expect that probably to continue on in the near future, just because there doesn't seem to be any buying opportunities, at least that people want to get into as of yet. The buying opportunities are out there, but people are still very negative on the group. But certainly we see reasons for people to keep dumping them, and we're seeing between 0.07%, so very low. But again, if you start doing 1% a week, that adds up over the very, very long term as far as redemptions go. So it's been a pretty big number on a week-to-week basis that we've been seeing. Let's go ahead and jump into our money market funds. And our money market funds have basically seen redemption or inflows, about $5.5 billion, as I said earlier. This is the 4th consecutive week that we've seen inflows, and how it broke out is taxable money markets funds saw about $7.5 billion in inflows, and how that broke out is institutionals took in about 5.6, and the retail money market funds took in about 1.9, whereas we saw tax-exempt money market funds actually lose about $2 billion. So, how to find a trend in money market funds? There really is no trends to follow here. We don't see anything happening on quarterly payments for taxes and the like. Again, we think that people actually took this opportunity maybe to take some of the money off the table, put it back into their, in their money market funds to see what happened over the next several weeks, what's happening in Syria, kind of sit on the sidelines to see what's happening. So that's basically what we're going to be doing as well. We're going to be taking a look to see what happens in Syria. We're trying to take a look at also what people are going to start saying once the rhetoric starts increasing over the debt ceiling. The debt ceiling has been brought up so many times. Everybody knows that we're going to reach it, but certainly now we're going to hear the politicians get out there and see if we can get a response to that. And also, a big thing I think we're looking over the next 1 or 2 weeks is what are the market participants that have been on vacation? What are they going to do when they turn back in the market? Well, if you want to do a deeper dive in some of the areas that you do research in for the investment classifications, you can go to our website at www.lipperusfundflows.com, or you can just meet us next week when we are going to have one of our analysts get up and talk to you about the flows in the mutual fund arena. Well, until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.